Good morning, everyone. Thank you so much for being here for our 28th episode and special edition episode. I have a all-star lineup of guests today. A couple of quick housekeeping things, of course. Manifest is less than a month away now, so if you guys have not registered, you are running out of time to do so. Please head to the link right here. We'll also have that in the comments. It'll save you guys $200. If you are going to Manifest, please leave a comment on the show or send me a message. I'd love to connect with you all while we're there. We're going to go ahead and just bring in all of our guests rapid fire this morning because I can't introduce them one at a time with having 4 on. And I also wanted to give a quick shout out to Thai TMS today. Meet Me for Coffee will be kicking off a new sponsorship partnership with Thai TMS, and we're going to have more to come on that in future shows. So without any further ado, I'm going to go ahead and bring in Mr. Rob Haddock, Chris Pickett, Ken Adamo, and Jason Miller this morning. Gentlemen, how are we all doing today?
Wonderful.
Awesome.
Morning.
We're talking about snow before the show went live. And some people are probably wondering where Samantha is. I know. I almost didn't know how I was going to make this happen this morning because I've been out of power since 5 a.m. We have a snowstorm going on actively, so I'm across town at my brother's house. So I appreciate them letting me break in while they're at work and host a podcast. But very thankful that we're able to get this podcast up and going. The stars aligned because I know you guys all have busy schedules. So we're going to take this opportunity and run with it. And Ken was like, yeah, I'm not that busy, you never. And we're going to go ahead and kick this off with some introductions. For anyone who maybe doesn't know all of you gentlemen, I'm going to start in the order that you guys are appearing on my screen. So we're going to kick it over to Rob. Rob, can you just give us a quick introduction on who you are and what you do?
Yeah, good morning, everybody. I'm probably the least busy as I have recently retired from the Coca-Cola company about 6 months ago. But I am staying engaged with the industry and looking to ways to give back some of the knowledge that I've obtained over the years. And my career has been wonderful. It's ranged everything from being in the boardrooms with the CEOs down to driving lift trucks in the warehouse. So had the full gamut across the supply, planning, and the logistics landscape.
Awesome. Chris?
Yeah, so Chris Pickett, Chief Operating Officer at Flock Freight. So Flock has really built the kind of the first of its kind scaled shared truckload platform that does really 2 main things. One, allows shippers to buy full truckload service. That's 1 driver, 1 truck, no terminal consolidation, only pay for the portion of the full truck that you actually use. Allows carriers a platform to really maximize the revenue yields of their fleets. In addition to my role at Flock, I'm also the lead market analyst at Pickett Research. We put out a monthly research note, roughly 45 pages of narrative, just trying to answer 2 simple questions. What are U.S. truckload, line haul, spot, and contract rates likely to do over the next 3 years? Prior to Flock, it's been about 14 years scaling Coyote Logistics with that early leadership team.
Awesome. And we're going to go down to the corner to Jason.
Hi, everybody. Jason Miller, Eli Broad, Endowed Professor of Supply Chain Management at Michigan State. Freight market economist primarily. So trying to read the tea leaves as well with a little bit of a different approach than most take.
Awesome. And Ken?
Hey everyone, I'm Ken Adamo. I'm Chief of Analytics here at DAT. I have responsibility for all of our market insights, data science, product development on the analytics side. Prior to coming on board here about 4.5 years ago, I spent about a decade in pricing, both in deregulated energy and for transportation, both non-asset and asset-based at a little startup out of Memphis, Tennessee, known as Federal Express.
Awesome. We just had somebody comment and say, go green. And I just need you guys to know that we're not bringing up sports on this show because these gentlemen will never get through anything else. So we're going to go ahead and launch right into today's topic because we only have an hour. This is going to kind of flow like a conversational style show like all of ours do. So I have some amazing people on obviously today that have a lot of insights. And I want to make sure we touch on a variety of topics today. Definitely weren't going to achieve that in 30 minutes, so we've extended it to an hour. But I'm going to go ahead and tee this up to Ken first, and we're going to just jump right in. And Ken, I wanted to ask you, and then everyone else, of course, feel free to chime in. But Ken, can you kind of give me some background? We're going to talk 2023 for a little bit, and then we're going to jump into 2024. So my question to you, Ken, would be, how did the 2023 freight markets either live up to expectations or maybe fall short of expectations?
Yeah, so from my perspective, entering into 2023, even sitting at the very end of 22, our perspective was the worst case scenario was a 2019-esque year. So that was my last full year in the industry, coming off the heels of the ELD and kind of weather-related maelstrom that was 17 and 18, and it was profoundly slow, especially coming off the relative insanity that none of us ever thought we'd see again prior to COVID. So I had a very recent and painful memory of what 2019 was like, and that was my, essentially my bear case for the year, and that's pretty much exactly what happened. If you look from a rate perspective, normalizing fuel out, it pretty much sat right on top, and by the end of the year was impossible to decipher from what happened in 2019. Now, kind of rolling into 2020, that year before COVID hit, we were expecting a recovery. We just didn't expect, a once every 100-year pandemic to be the source of that recovery. But when I look back in the rear view of 2023, I just reminisce a lot about what 2019, and to a lesser extent, but to the same degree of angst, how 15 and 16 felt.
Okay.
So,
Well, I joined in the industry in 2019, right at the beginning, though. So, and I was actually in operations in the LTL space for the first 6 to 9 months. So that's as far as my full truckload memory can take me, really, is late 19. And so I always have to rely on hearing you guys talk about what happened before that to be able to draw my comparisons. Anyone else have any thoughts on 2023 and maybe how it was different than what we thought it was going to be, or exactly on target? Or
Yeah, I guess I would jump in and kind of look at it again. I'm a disciple of the cycles. If you've spent any time with me in the last 10 years, I'd probably mentioned a curve at some point. And so some of these episodic periods of overshoot and collapse, and I would argue that that 19 malaise was a direct response to the surge in 17 and 18, and then the back half of 22 and in here 23 as a direct response to the COVID surge, which was partially driven by all the cap that exited right in 2019. So I think the depth of the downturn, I don't know if that was a surprise given how high the high was,
right,
and how profound that pull forward was, where kind of the rest of the global economy was, fighting for its life, but yet supply chain was off and running. And this is the reckoning, I think, that came from that. I think what has been a bit surprising is the duration. I think we kind of had expected at least some meaningful recovery, probably by Q4. And again, there's a whole kinds of reasons why that may or may not have been the case. I think my leading theory is, fuel got so cheap that first half of the year that I think that allowed more of that overcost and supply that entered in the boom times to stick around longer than they otherwise would have. But the shape of the cycle so far really hasn't been that fundamentally different. I think it's been the duration's been a little bit of a surprise.
Yeah. I mean, me personally, I would say that that was kind of a surprise to me, because I think that we all knew that there was going to be a low, and we just expected the low to kind of start changing a little sooner than it has. And looks like maybe it will be, but we'll get into that.
Hey, Samantha, hey, just additional, from a shipper's perspective, the goal of the shipper, I think, always is trying to balance the service and cost perspective. And transportation doesn't seem to be, it's never top of mind in a shipper's environment because it's kind of the last thing in the supply chain. And a lot of folks don't really understand logistics. They just know it happens. So you're constantly battling between, do I service the customers at a level that meets the expectations that we've made from a sales and marketing perspective and our service guarantee, or finance wants to see the lowest possible cost. So you're kind of that buffer to make sure that you've got enough money in the budget, not too much. And I've always said it's easier to give money back than it is to go ask for more. So
Right.
You want to be able to understand the projections, go a little bit long, and give money back over time. Don't wait till the end of the year. But as the market doesn't behave the way you expected or as bad as you expected, put that money back in the kitty.
Right. Okay. Well, kind of similar along these lines, I'm going to kick this one over to Jason to let him chime in here. Jason, how has the macro economy lived up to expectations, or maybe fallen short of expectations, or exceeded expectations?
So I would focus this, really two big things in terms of exceeded expectations. First is just how strong the labor market stayed through 2023. If you look in middle and end of 2022, pretty much every major bank, vast majority of economists are saying we will have a recession in 2023. That never materialized, and that was because the labor market's been as strong as it has, and it's still very strong. The other thing is I'm going to actually say is how effective the Federal Reserve was in 2022 and 2023, and that we have tamed inflation. I mean, inflation is down now to about 3% year over year. Pick your metric, which is phenomenal compared to where we were 18 months ago when it was 9 or 10%. Pick your metric. And we avoided having a banking crisis around March of 2023 when we had Silicon Valley Bank fail. And so I would say it's been very, very much on the upside that we didn't have a recession. And really, there's no indicators right now that one's coming. So it does seem that the soft landing that most folks thought was impossible will actually play itself out here in 24.
Yeah, that's exciting. We're gonna have to talk about that a little bit more. I feel like I get too repetitive at times with my topics on this show and also with my newsletter that comes out every month. But I think anybody who's been following my work has obviously known that I've been, kind of talking about the potential for a soft landing since before I think that was looking as likely. So I'm excited to see that. I've also heard some different ideas now about a no landing theory and some other things. So we'll see what materializes. But anybody else, just as you guys are participating in freight markets, feel any impacts of the overall macroeconomy in your sectors of the industry as well?
I guess I think a little bit surprising with the relative strength of goods consumption. So I think spot on with your last comment around the labor market has stayed strong. Consumption is still surprising everybody, whether it's retail sales or whatever you look at. I'm just kind of looking at under the hood of consumption and kind of what services have done versus durable and non-durable goods, at least on a year-over-year basis. There's that kind of prevailing narrative around this wide-scale shift of goods consumption to services, and nobody wants to buy any stuff because we already bought all the Pelotons and the garden furniture. We want to buy. Right, so we want to buy trips and vacations, and everyone's going over to Europe and kind of whatever else, and that may be true. But if you look at kind of what is happening with overall goods consumption on a year-over-year basis, it's actually held up. And like the last couple of quarters, it's actually growing faster than services. And so I think that's done much to somewhat buoy the level of overall truckload capacity demand. And I think the challenge this year has it's been that surplus of supply that flooded into the market, as it always does, when times look a lot better. So I think some of the green shoots going into 24 is, I think the primary driver behind the freight recession or the trough in rates or whatever name you want to call it is fundamentally driven by, I believe, an oversupply situation where so long as that demand stays stable, it doesn't need to go off to the races. I think that there's a really strong chance that we do see a spot market rate recovery, at least by the middle of 2024, even without a great economic recovery. I think on the back of just that overall level of actual material goods consumption that has stayed stable, if not actually creeping slowly up into the right.
Yeah, I'm in the same boat, Chris. I think my opinion is, absent some exogenous event that we didn't expect the last two times, this will be a supply-driven recovery with maybe some tail breezes if interest rates tick down. Like, I'm watching that builder subsidized interest rate, if that goes below 5, and you start to see people moving around again, and lumber's cheap, really, really cheap right now. I don't have many hobbies, so I track the price of the stud length 2x4, and it's below $2 a board in my area. So I think there's a lot of things that could, and I call them tail breezes because I don't think they're quite winds yet, but at some point we're going to reach equilibrium on the number of carriers out there. We've already lost about 30,000 interstate ones. So, but
I do believe that demand side is important, and I read a lot of what Jason published, especially kind of what's happening in the housing market and the level of builds, and that's absolutely, I think, going to be a profound wild card going into, I think, the magnitude of the recovery. So I think there can be a rate recovery, but again, there will absolutely be some demand tailwind that's going to be required to push it near the levels of what we saw in, say, 21 or 17 and 18.
Let me do this real quick. Let me back up on your topic, Chris. You were talking about kind of what that's done on the provider side and the carrier side. What about? I mean, we're in 2024 now, so we're obviously going to spend a good portion of this talking about 2024. But we had some pretty significant events go on in the provider space in 2023. I think that caused a lot of people to have hesitations, be concerned. Some companies close their doors, carriers and brokers. And so what did 2023 change in the landscape for service providers? And what were some of the challenges that, while yes, we can talk past tense, right? Like they went
Yeah.
through these challenges in 23. Nothing significant has changed yet into 2024. So what are these ongoing challenges that providers are going to continue to face as we phase out 2023 and move into 2024?
Yeah, I mean, no two ways about it. I mean, 23 was brutal. It doesn't matter if you're asset, non-asset, asset curious, whatever model, you
Asset curious.
whatever
I love that.
you look to deploy. I mean, it was a tough year where there's a thing that always happens, where it's, one, it's the second year of the deflationary leg of the cycle. And in the second year, nobody gets out alive. Either the first year, when spot rates crash, they crash faster than contract rates. So if you're a large scaled asset or non-asset, mostly you're non-asset because you're buying in the spot market, there's a couple of quarters, and I think you saw it kind of Q2, Q3, 2022, where it was probably record gross profit time for large scaled, non-assets that had large contract books. And that's fantastic business while you got it. The challenge is by the end of that calendar year, procurement cycles kind of set in and all that contract freight resets down at the spot market, and that lasts the duration of 2022. So if you didn't materially take down your OpEx or pivot or do something in anticipation of that, then 23 was just a tough year because you just had consistent margin compression that came into conflict presumably with your OpEx. So that's the thing that always happens. And was the impact more brutal this time around? Arguably, probably just the level of magnitude. But there are kind of two other things that also happened where you had this surge in. I mean, you always have double brokering, and again, whatever happened accelerated that. But just the outright fraud, whether that's the proliferation of digital platforms or the crooks getting smarter, or just a function of the economy as a whole, a massive rise in fraud, which created a ton of visibility and I think a mandate for investment in digital security tools to just kind of firm up the chain of events that led to, especially the non-asset getting the load and then arranging the carrier and then whatever truck showed up to pick up, write that thing, and then hopefully that truck actually delivering where it was supposed to deliver. And you couldn't go a day or a week without seeing something on FreightWaves or kind of wherever else around the next wave of fraud. And I think also created a massive headwind, for providers of all shapes and sizes. Or at the very least, it's distraction, it's extra cost, you have to invest in security, all good things, but extra headwind. And I know that what I understand that specific events did put a handful of providers out of business. And then the third was, I think the fall of Convoy. As just an example, where it was almost, I think the veil was pierced as to the case that, DFM, if DFM is just a euphemism for tendering freight over an app, by itself created enough of an edge to build a sustainable network model and create competitive advantage. And I think the lesson, I think Convoy did a lot of great things, great investment in tech, a lot of great talent in the industry, and that we've all kind of read the story. But they're just making the point that the tech in and of itself is maybe necessary, but not sufficient. And I think, lots of great tech innovation, whether it's carrier identity, whether it's API pricing, whether it's real-time visibility, load matching, all these things create value. But I think that the tech in and of itself, at least the current iteration of tech, I think isn't sufficient to build a large-scale service provider. You still need the humans. It's very much a human plus tech game.
Yeah, I think so. I'm calling this, and I'm sure this term's already out there. It's not unique to me, but I've been talking a lot about a tech-enabled model instead of a digital. Like we called it digital brokerage or digital freight matching, but now I think it's tech-enabled or digitally enabled, where we're leaning on people still heavily in traditional processes, and then automating as much of it as we possibly can, where it makes sense and where it's efficient, and using people to teach automation. And I think that's a beautiful, like the way you laid that out, Chris, makes perfect sense to me, because it's like we jumped really just head first into all of this, especially since COVID. And then I think 2023 was like that learning year and that shift of like, okay, maybe we did we pushed a little too far into certain aspects of this in ways that weren't really sustainable. And
I think
so
one of
now
the upsides is that it has driven a lot of investment in the industry, and there's a lot of great tech that has come in that you don't have to build it all yourself. You can build a world-class tech stack with off-the-shelf components, I believe, in this market. You don't have to do the same things we did at Coyote in the early days, where a lot of great things you can build. So I think it's that awareness of it's not just the tech, it's not just the humans, it's the tech enhanced humans creating, I think, the best outcomes.
Yeah, guys, before the show started, I accounted for the dog and put him out. I accounted for the fish tank that was bubbling, and I forgot about the cat. So there's a cat now that needs my attention. I'm trying to pet him to keep him quiet. So bear with me. I have a question here before we move on for you, Rob. It's very similar, kind of where we just talked to Chris about what did 2023 kind of change for providers. What was the maybe new challenges or ongoing challenges or shift for shippers in 2023? I know that 2023 was coined, I think, for all 4 quarters as a quote unquote shippers market, right? So what did that mean for shippers throughout 2023? And what does that kind of mean as we are coming out of 2023 as well?
Got it. So a little bit of background about me. Jason, you'd love to know that I'm an econ major back from Hiram College. So it's interesting, the pandemic, and even before that, the ELD meltdown, it started to really showcase how the economy and transportation were linked together, which many people don't quite understand. The basic supply and demand that goes on between trucks and moving goods around. But it was a great forum for a shipper to really have the conversation with senior leadership, because they're explaining why all of a sudden do I have to give you an extra $1 million, or why all of a sudden is there an extra $1 million that you're giving back to me? In the past, it was just like nobody really had an understanding. But when you started to explain the economy, and then you could see the economy on the news, and then they also blended in some transportation or logistics ripple effect. Everybody's going, oh, okay, there is a direct correlation between how the two interact.
Right.
Now, I would tell you for 2022, 2023 results, it was a year of relaxed. Very similar to what we saw after the ELD, and it's kind of the second time that we had a break, if you were a shipper, to kind of assess where are you, what do you need to do differently. But I would tell you, even as we were getting ready for the 2023 year, which means we were budgeting back in 2022, we thought that there would be some level of inflation, because that's what everybody we talked to said, that there will be some inflation. But then it didn't happen. And we started to give money back. And then people will ask, well, is this real, or is it going to last? So then we had to kind of say, okay, well, why? And then we started to look at where consumers are spending their dollars. And during the pandemic, everybody was hunkered down. They were spending it on goods. Goods take more trucks. Now everybody's out traveling and doing service-related expenses, so less trucks. Capacity goes up. The other thing that most people don't realize is that many shippers during the pandemic could not fulfill their truckloads. So they would have just enough goods maybe for 3/4 of a truck. So they would get it on the road because they wanted to keep stuff on the shelves, because everybody was buying everything that was possibly available.
Sure.
So for about a year, it was a self-inflicted capacity constraint, because what used to take 4 trucks was now taking 5 trucks or 6 trucks to get the same amount of goods to market.
Unless they were shipping shared truckload with Flock.
I was going to say,
Exactly,
Chris
Chris.
better give himself a shout out here.
Good plug there. I walked right into that one, Chris.
We want to team him up.
We did not plan this, I promise.
Yeah. But I started to see as folks were done buying everything that they possibly could, then inventory started to rebound, payload capacity started to go up. So that helped reduce the overall requirements on how much demand. So as a shipper, as we think about why, now we kind of know why. And the other thing is, we talk about all the people that came into the market to be a truck driver, and now we've got all the revocations. From the shipper's perspective, we're really curious. Okay, the organization that represented that DOT number is now gone, but where did the driver actually go? Did they land with somebody else, so we didn't necessarily lose capacity in the marketplace? Or did they go to a different line of work, maybe last mile, maybe warehousing, maybe construction? That's a big wild card, because the owner-operators don't necessarily get picked up by the Bureau of Labor Statistics until they're on somebody's payroll full-time. So that's always a fungible number that nobody has quite a good idea as to where folks are coming from or going to in the owner-operator space.
Can I get maybe Jason or Ken to weigh in there? Because I know that that's something I hear you guys discuss a lot on the payroll and trying to understand what's happening with the capacity side of things. Any thoughts?
Yeah, so it's a very complex topic, because when you think of the owner-operator world, we've got for-hire owner-operators. So individuals, DOT one truck, have their own operating authority, solicit their own freight. Then we have your lease capacity. So I have a truck, maybe a trailer, but I lease on as a 1099. The challenge is, no matter that model, you have to have a legal form of organization for your business. It could be a proprietorship, limited liability company, or the fun piece is the S Corp, which we know from census data, 55% of trucking firms with 1 to 4 employees are S Corps. I bring up S Corps because I can be a owner manager with no employees, but declare myself an employee for tax purposes. There's a very likely issue that a lot of folks do that who are owner operators. That means you're an employer firm. That means you get picked up by the data when the benchmarking is done to the unemployment insurance taxes. We do know from Census Bureau data that does link in quote unquote non-employer firms. So this would be everybody who is not, is a true self-employed individual and employer activity. Roughly 18% of truck transportation revenue goes to those non-employer firms. That number has been very steady since 2018. So 2018 through 2021, that number is constant. So it's reasonable to assume it's the same. So what I would say is, I think that we can look at movements of the employment data and have pretty good confidence that that is capturing capacity. Right now, the big thing is we have an annual benchmarking coming up in February that is probably going to magically result in truck transportation payrolls looking like they declined 3%. And that's because we've been overestimating where that's at due to some technicalities that we don't need to go into. So what I would say is it is an opaque topic, but my guess is the BLS's data captures more of the owner-operator universe than what we think, because we can very confidently say that probably not everybody is self-employed in that data.
Okay. I did my best to track that. I think I probably understand about half of
If
that.
anyone is interested, send me an email. I will happily explain that because I've had to do more research into it than I've ever thought as well. The other way to think about the universe, if folks are really interested, use the motor carrier census files and then link in the inspection files, pay the money, and get a database for that. Figure out what proportion of inspections of entities with for-hire authority have 1 power unit versus not 1 power unit.
Right.
That's a pretty good proxy. I've used that in research with my colleagues, and that number lines up pretty darn well to where the Census Bureau's number lines up.
Right. Okay. We're going to come full circle on pretty much everything we just discussed. We were talking 2023 a lot. We talked a little bit of 2024, but I want to make sure that we have plenty of time to dive into what's happening now and what we can kind of be expecting over the next 6 to 12 months, and answer any questions if we get any coming in from the audience as well. So Ken, I think I'm going to kick this one back over to you. We talked about freight market, living up to expectations, meeting, exceeding. I'm just going to pose a very similar question for 2024. I think already people anticipated we would be in a different type of environment, either by Q2 at least of 2024. I think people are already starting to push those hopes and projections out farther down the road. Some people might still be talking about some changes starting in Q2, but the tone has definitely changed in the last 3 or 4 months, I would say, especially. And so from everything that we can try to observe and what's happening right now with data right now in the industry, where do you think we're headed in 2024 when we're talking about rates and volumes?
So I'm kind of in that end of Q2 camp. My guess is that some point in Q2, rates on a spot basis will flip year-over-year positive, adjusted for fuel. I think it'll be a more tepid recovery. I think some of the major things to track to see if we're heading that direction would be if the Fed kind of comes through on what they've been talking about on interest rate decreases, new housing starts, 30-year mortgage rates, things like that. I wouldn't expect anything like the last 2, right? I mean, there could be some shock that happens that causes that. But when I look at the market, it's probably going to be something more like that 2013 heading into 2015 upcycle than the 17, 18, or certainly the 21, 22 upcycle. If I had to make any sort of historical comparison, I internally, I call this the 2 bites at the apple hypothesis, in that I think it'll take us 2 cycles to get back to our COVID highs, kind of on an inflationary basis. I don't think we'll get back there all at once. So I think it's going to look weird charted over time to have 2 really strong examples of the picket line or coyote curve, and then probably a weaker one following it up after the COVID cycle. But that's my general fully disclaimed, non-guaranteed perspective.
Chris, he teed you up to weigh in there.
I know. Yeah, I don't know. I mean, even prior to COVID, if you look at kind of the last 10 or 15 years, which is the historical term I look at, just we started moving freight at Coyote in 2006. My first year-over-year comp is 2007, and there has been a steady, I guess, pattern of higher highs and lower lows. Again, it's a year-over-year index, so there is that cold spring impact of if you have a lower low, then by definition you probably get a higher high, which drives a lower low. But you've seen again the steady trend of that, and then certainly impacts of COVID, and then storms can come along and kind of exacerbate that when you're up in the peak. And I don't know. I haven't seen anything structural that's fundamentally changed in the industry, especially around just the level of overall fragmentation or not. I think if anything, things are more fragmented, which I believe leads to we're more likely to see these overshoots. I think the kind of the unforeseen impact of the digital transformation of freight, more and more freight's out there on an app, actually lowers the barriers of entry, right? So if rates look attractive, before it's like you go get an operating authority, go to your CDL, surety bond, you too can live the American dream and jump into a hot freight market, but you still had to get to know, again, if you're a small carrier, you're by definition mostly vulnerable to the spot board. So you need to get to brokers or learn how to navigate the data or kind of wherever you get your spot freight. There's still a process. Now it's you can download 4 apps, you get access to tens of thousands, if not more, which is you can't look at that and say that's not a great thing. Like you're enabling.
No,
right,
and I have quick confession on that note. I mean, I was just talking with a CEO at one of my clients' companies, and he was telling me about how they used to have everything was faxed, like all of the tenders and everything were faxed back and forth, and you would write things down, and then the truck stops were actual you had to change the screens, and somebody had to go in there and put what loads were available.
Put the post-it note up on the wall. Yeah.
And I was like, oh,
and it wasn't that long ago.
God.
I mean, that's 2005, 2006.
And so you talk. That's what I mean. I'm like, we think to me, I hear that, and I'm like, what? Yeah, what was that? Like the 80s? Like no. So it wasn't that long ago that we were so. It was so much different. And so when you talk about that, I think I'm going to go ahead and bring this up just because so many of the people listening, and I see people in the comments already this morning, are 30 something or younger and maybe been in this industry for the last 5-10 years. And if we just go back a little farther before that, this was such a dramatically different space. And the progression of the last 5 years is quite impressive, even compared to the 5 years prior to that.
See these, Samantha? When I started, these were my tools: paper and a writing utensil.
Yeah.
My point is, go ahead.
I didn't want to totally derail that conversation, Chris, but I think that we maybe under exaggerate what has really happened in the last, again, 5 years. We made a lot of tech advancements prior to the pandemic, and then since the pandemic. I mean, I was in sales, and we didn't have Microsoft Teams before. Why would a seller need that? Why did we need that? We could just communicate through emails with our team members. And so just the world really changed quickly. And so I'll let you get back on that train of thought if you can, but just how much is happened, and the accessibility to everything is really astounding.
For sure.
I mean, we have to take that into consideration when we are talking about these market cycles.
I think the point is, I guess my experience is that the volatility and the market reaction is much more driven by just the market psychology in a fragmented market with low barriers to entry than anything else. Right. So in a hot freight market, as human beings, we have recency bias. We believe it's always going to be awesome forever. So let's get into the market. And all of a sudden the spot market changes, and we find that, hey, sometimes it's not awesome, and there's a reckoning. But the system will have breaks in terms of before, whether you had to go through a process to get access to spot freight. Tech has lowered those barriers. The used to be natural breaks where, hey, if the large national carriers wanted to buy more trucks, there weren't supply constraints. This time around was different. Arguably, maybe you wanted to buy trucks, but there were,
Good luck.
yards full of, partially assembled, Freightliners out there where, the books were closed and you couldn't. And that in and of itself may have actually saved the supply side from overshooting more than they otherwise would have.
Right.
And so I think as you take down those natural barriers, then it almost makes it easier for us human beings, greed-seeking kind of human beings operate in a market that's structured like this to continue making the same decisions, arguably mistakes, over and over again. So all of that to say, as we come through the correction here, where enough surplus supply exits, like my forecast is, I think we're year-over-year inflationary at the end of Q1. Not a ton, 2 or 3%, which is probably a 5 to 10% move from current rates. And I think spot rates are 30-ish% higher, by the end of the year. And, whether that gives the higher peak that we saw this time around, we'll see. But again, all the stuff that can happen that we'll call a black swan, but the likelihood of a big storm happening, come, end of the year or early Q1, we didn't get a big one this time around that, hey, maybe we're due. Then all those things you can kind of, manifest themselves to push those peaks even higher. And so again,
I do have a question, and I'm going to open this one up to all of you guys. I think maybe some of the audience might kind of be aligned with me here in this line of thinking. And I guess it's idealistic based on at least that opinion. I would have hoped that as we see more progress in the industry and we have more people being able to predict what may or may not happen with capacity and volumes, and there's just more data available. When I'm talking with clients or when I'm working to scale brokerages, I talk about sustainable revenue in the sense that if you can find carrier capacity, carriers understand their cost to operate, you take that into account, you price accordingly, you put margins on, we should be running pretty stable rates, regardless of all of the different variables that can impact a market. And then obviously you can adjust some for the demand that's placed on your available assets or for new business. But I'm kind of almost confused why the cycles are becoming more dramatic and swinging higher and lower than I kind of foresee it as like, hey, why can't we just kind of ride some subtle waves? Because we all now have the available information to make more educated decisions when we're pricing freight instead of.
I can give you an answer for that.
I'd love for you. I know that sounds very idealistic, but it seems frustrating that that's not where we can start to work towards instead of farther away from that.
Yeah. So to me, it's when we have demand fundamentally increase. I'm going to go back to the 17-18 market cycle because we forget about 20 through 22. That is like such a black swan. We really shouldn't focus on that. 17 and 18, you've got about 4% growth in ton mileage. So in fundamental demand in late 17 relative to late 16, and that 3 to 4% growth continues through mid 2018 or so, and it starts to slow in the back half of the year. You got to move freight regardless of what the transportation price is. So you've got essentially demand that is what we would say is exogenous. It's determined by other factors. There's capital investment. There was a big commodity market boom in 17 and 18 in fracking that often gets forgotten about, as well as huge amounts of CapEx because of business tax cuts. So we have all this demand starts taking place. Supply in trucking is limited. You really can't add that much supply for about 6 to 9 months at least.
Right.
And so you've got to move this freight. You start having some tenders rejected because carriers with contracts can't really deal with overflow capacity that well. That puts more freight on the spot market. Spot prices go up. And then we kick off our cycle that takes place. It's because demand is really inelastic to price. You're going to ship regardless. But supply is super elastic to price. Spot prices go up, we add supply, but with a lag. The key thing always is once we start seeing an uptick of demand, we don't have the supply to capture that at this moment. And then that starts making things go. I would argue the increased availability of data may actually make things worse because we create feeding frenzies. Like if you look right now, let's imagine we get into May and spot prices start getting out. I'm going to include fuel surcharges right now, but using DATS data, they're like what, 215-ish right now, Ken, so far, let's say 210, 215 a mile for dry van. Let's say we start seeing fuel not move and that number gets towards 220, 225. What's going to happen is the psychology of how carriers are bidding on those spot loads is going to start changing. They're going to start edging it higher.
Yeah.
And we can all see that data in real time. And that's when you start getting the frenzies starting to take place.
Jason, question for you. Do you have a favorite list of early, leading indicators, economic indicators that kind of, you can look 90 days in the future, and if this happens, this correlation, is there one or two that you always are your go-tos?
So I just go straight up, and Ken, this is not me pitching DAP, but I found this is the most accurate thing.
No, please go ahead. Tell me more. Tell me more.
We've talked about this a lot. I posted on LinkedIn, but it's comparing the broker buy contract price to the spot price data, including fuel. Ken, you and I've done the analysis offline. It doesn't matter if you do or don't have fuel. It's the exact same conclusion.
For this analysis, yes.
Yeah, for this analysis. But it's a ratio of those. Once those start getting close to each other, the magic threshold seems to be 10% with how I calculate it. That's when the market flips. And that's where this discussion of a much more gradual change in the market, if you look at 13 into 14, it's a very nice, smooth curve. 17, we get in the middle part of the year, it gets much more dramatic. 20 is just outlandish. We literally go from terrible bear market to insane bull market in 60 days. That's not going to happen. Same way with how that index works in 22, we went from incredible bull market to bear market in 60 days. In terms of leading indicators, housing starts are important. I would say a big thing is real wholesale sales. So inflation adjusted wholesale trade sales are very indicative of where the market's going. And then industrial production of manufacturing, strip out high-tech products, strip out pharma. And then I'd say last but not least, anything commodity market related. So if you're looking at, let's say, drilling activity and rig counts and things of that sort. That's why I'm a little bit more bearish, I think, on 24 than the other takes here, because I'm looking at sectors like machinery production, and it's down, it's weak, it's not going up. Commodity prices are down. There's not going to be as much oil drilling. There's not going to be farmers buying farm equipment like they have the last couple years. And I'm going to throw one crazy wild card out there. I'm posting on it later this week. But Ozempic and weight loss drugs. Food and beverage production in this country is down 2% from where it was in early 2023. Walmart's already saying people are buying less food.
Yeah.
Food and beverage production is 18% of trucking demand measured as ton miles.
Yes.
That all it takes is 1% less food consumption, and that is hundreds of thousands fewer loads that typically move a long distance. And so I think that there's more headwinds in 2024, at least the first half. Once the Fed lowers rates, then the question is, how does the market respond? We'll have more single family housing starts, but where housing construction is down, we know that for sure in terms of new starts.
And I actually had a warehousing real estate construction specialist on who said that that's been oversaturated to the point where they don't expect a lot of activity recovery in the next couple of years in that space too.
But isn't capital investment in manufacturing way up? I mean, the last 2 years.
So that data is, I think, very misleading because of the secular shift towards building super expensive chip and EV plants. And I like to think of it as what matters from a freight standpoint is how many square feet are we building, not how much are we spending. And I am 100% convinced that data on construction spending for manufacturing is getting way overblown in terms of its freight market impact, and not only for building the buildings, but long term. I mean, we're in a brutal reality that you strip out high tech and pharma, manufacturing output today in this country is below where it was in 2019, after it had declined 4% from 2018. And it's like where it was in 2011. So when people talk about reshoring and freight volumes, I'm not seeing it. There'll be some cross-border trade with Mexico that picks up, but that may be cannibalizing, freight that was coming from China through the U.S. West Coast, and you had ultra long distance truck trips from time to time if it wasn't being intermodal.
Yeah. Rob, I don't know if this is a question maybe you can weigh in on, but do you think that after 2020 through 2023 even, do you think that there's going to continue to be port diversification for shippers bringing in any type of imports, or maybe what have you heard, or are we going to see this reversion back to the U.S. West Coast pretty significantly?
I think it's probably mixed. I mean, the Coke network, if you think about it, is really domestically sourced in most cases, but there are a few things that come in from offshore. But if you're heavily reliant on China and that part of the world, you know, if things do stabilize over there on the West Coast, then I think folks will gravitate back. Yeah. Although the East Coast ports are doing everything they possibly can to up their game and hold on to their newfound capacity or demand that's coming through there. It is a huge ripple effect. Many people don't realize that, you know, when things hit the ports, regardless of what port it is, it's got to get off the ports and start making its way inland. And most of those, you know, shippers who own that freight will do whatever it takes, which then has a ripple effect on those markets adjacent to it from a capacity perspective.
Right. Okay. Well,
I was going to say, funny enough, I was just calculating that because the Census Bureau just released the data for November.
You mean I think like a professor? Is that what you're saying?
Yeah, no, exactly. And even though with all the discussion, if we just focus on imports from Asia, so all of Asia through the West Coast versus the East Coast including the Gulf, so Gulf and East versus West, summing together October and November, it was 47% West Coast, 53% East and Gulf. That is better than what it was in 22, where that figure was 44. But if you go back to 2018, it was 54. So,
yeah,
no,
a little bit of improvement. I think a lot of people, obviously, I mean, everybody's opportunistic, right? That's why we have the cycles that we have. I think as exaggerated as they are, because everybody's running a for-profit business in this space. But I think definitely
not Convoy, but yes.
When those markets
are long,
too soon.
I didn't say anything.
I think that a lot of those locked in multi-year contracts to run through certain ports, warehousing deals around those ports and all of that. So I do think we still maybe have to see out those 3 and 5 year deals and then see what decisions are made in the future. We have 12 minutes left before I think a couple of you guys might have to drop off right on the mark. So anybody who has questions, if they want to start putting them in the comments, we'll definitely try to get to those. And then in between those, I think I want to open this up for open discussion across all of you for kind of maybe your final, you know, two second take on where are we going in 2024, and kind of maybe a call to action on your prospective parts of the industry. What should people be thinking about? What should they be prioritizing? And what should they keep top of mind or keep checking on regularly to understand where we're headed? And so that's kind of my question that I'll kick off to you guys. Is you want to go ahead and someone jump in and take that, and then I'll look through these questions we're getting in the comments and moderate that.
I would kick it off and say February, we're going to get the big retailers' earnings for this holiday season. You know, back in 2022, there was a huge red flag in that they had overordered terribly. We could see that inventories were substantially elevated relative to sales compared to prior years. And that kicked in sort of this inventory accelerator correction cycle that really hammered imports in the second half of 22. And much of 23, I mean, we regressed to the long-term mean. See where the big retailers are at. Home Depot and Lowe's are, to me, especially interesting because that's that building material side of things. You got to be watching spot prices relative to contract prices. Watch tender rejections. I mean, I'm checking FreightWaves every day on their little free box to see where tender rejection rates are, and they're still like 4% right now. So capacity is still plentiful. And I think right now it's a demand story. And unfortunately, I'm just not seeing this first 6 months where this demand is going to come from. You know, U.S. manufacturing really took a beating starting Q4 of 2022, and it has not gotten better.
And I will also say I can echo that. I talk with a lot of brokers now, a lot of carriers, and it's been the rhetoric now for most of 23, and even now, especially Q1 of 24 is always brutal, right? But that's what we're hearing from people who predominantly move CPG products, food and beverage, different types of industrial products, construction materials, and the volumes are just down significantly enough that it's hurting the providers who were running those contracted lanes. Even if they still own those contracts, the volumes are somewhere between 4 and 10% less than they were prior months. And so I think that hurts a little bit more. And that's all an offshoot there of decreased manufacturing activity.
Yeah, I would jump it. I'll probably, as you can tell, maybe a little bit more bullish on the price action.
Which I love, by the way. This is why we have everyone, right?
Regardless of whether we get kind of the demand surge, and I would kind of give the counter kind of wild card around the Ozempic and the weight loss drugs, where I think now surveys and data are showing that once you get off the drugs, you actually eat more. And so it's that cold spring where there's the wave on the drugs, and there's some long-term issue that gets identified, and then we're back to over consuming. But regardless, let's say that whether the spot rate surge in the end of Q1, like I think, or Q2 or Q3, whatever the timing, I think routing guides will come under some pressure. It doesn't matter kind of what happened in Q4 if that's when you locked in your contract rates. There's going to be some pressure, and there's going to be some spill from contract into spot, and there's going to be some rebidding. And this will be the great age of the mini bids. This is probably the most dangerous part of the cycle. Where again we're set based on what's happened the last 2 years, and however bullish I pretend to be, you're still weighed by the recency bias right of the past. And so what's going to happen, whether it's Q2 or Q3, whatever it is, all that, everyone's routing guides, not everyone, but a lot of routing guides will start to spring leaks, and shippers will be scrambling for other options. So I think, while there's still time and there's still relative tranquility on the marketplace, I would urge most contract shippers to just increase your optionality and look at modes maybe that don't make any economic sense right now, like intermodal over some lanes, like again, shared truckload is probably a club you want in your bag. Look at LTL, all the ways you could move freight, even though that they might not be kind of financially optimal right now. What happens when rates are 10% higher? So I think the point is, draw that playbook now such that, when the market landscape does shift, that you're in a position to react just that much faster than your competitors.
Chris, I'm going to build on that. You open up the door to talk about shippers.
Yep.
I've been a big shipper of choice proponent for many years. And I think now that the shippers still have a little bit more time before chaos ensues. Make sure your strategies, your processes, your tech are as refined as possible. There's no reason to be surprised by the next downturn as to you weren't ready. And I would, two simple things. I think if you've got facilities, respect the drivers, keep them moving.
Yeah.
Your carrier partners, make sure you're in the top 10, favorite shipper list of theirs, because when capacity gets tight, decisions will be made, either by the driver or by the carrier, that if you're not worthy of them coming to visit you and pick up your freight because of X,
right?
You're going to have to jump higher to get your load covered.
I've challenged some people to on the shipper side, I think in a recent show talking about something along those lines, to consider where Jason just touched on 4% tender rejections. A lot of shippers allow for 90% acceptance or somewhere close to that. And so if you were to experience anywhere from 2 to 8% of an increase in tender rejections right now, and that were to push into spot, you might not be as affected in this market, but how will that affect you when things change? And now how far above your contracted rates are your spot rates sitting? And what does that actually, just do the number, make a calculation on 10% of your freight going at a 15 or 20% increase over contract rates for the duration of your bid cycle. And what does that do to your bottom line and your budget projections?
The other thing I would say, get really good at lane management, because, you awarded a certain number of lanes under expectations that those lanes were going to move at X loads per week.
Yeah.
If you're terrible at that, don't hold the carrier accountable for poor performance. You got to get better on what do you actually need to move from A to B, and stand behind it. And work with your carrier partner to make sure that you're not, giving them a bunch of ghost signals.
Right.
Rob and I are going to be back on another episode to talk about ghost lanes, I think. So, anybody else thoughts to add?
I think just to put a bow on what I've talked about a little bit, I haven't seen this much animus in the market between brokers and carriers specifically since May of 2020, whenever there was the White House protest and things like that. And I think it's a dangerous game, right? I think in the brokerage community, there's a lot of whistling past the graveyard that's happening right now, right? A lot of sweaty investor meetings and earnings calls. And I just did a comprehensive study on broker margins, and they're really at the low end of a historical spectrum. And I think what we need to level set on is brokers and carriers are two incredibly low margin businesses that are pointing fingers at each other right now, right? When all is said and done,
Yes.
most brokerages are making 3 to 5%. Most carriers are operating at 95% operating ratios. And brokers gained a substantial and aberrant amount of contract volume through COVID that they've hung on to largely, which is in no uncertain terms an absolute boon for the small carrier, right? Small carriers aren't going to knock on Coca-Cola's door, I presume, Rob, and get 3 loads a week, 3 cherry loads a week, right? They're going to get that from a broker. So now's the time when it's most tempting to burn bridges, I would say. And I would encourage folks to take the tinfoil off, right? We're all moving in the exact same direction. And we all should have each other's best interests in mind. Because when that market goes back up, we're all going to need, right? We're going to go back to needing capacity. We're going to go back to needing our partners. We're going to go back to needing to get competitive bidding for lanes with our shippers. And this industry is a pretty tight circle, right? You might not be too surprised to find someone who you may have like abandoned their bid pop up at a different shipper, and they're all of a sudden running the RFP next year for an incumbent lane. So the golden rule seems to apply here.
Yeah, absolutely. And I do think that, man, that's another part. Maybe that's another big negative of the accessibility of everything that we talked about earlier. Because as all the freight has been on here, so has all the communication and the chats and the groups and the pages and the blogs and the Reddits, and it's just a little out of control as well. I don't even look at any of that, but it's enough to know that it exists, right? And I think that that's just more of the fragmentation that we experience in this market.
But I think
questions.
I think just to Ken's point, it's you got to play the long game, and I think the shippers and the carriers and the brokers that do really well are the ones that partner up with trading partners that they trust. And if you're trying to figure out who those trading partners are in potentially inflationary 2024, it's how did they react in an inflationary 2020 2021? How did they react in 2023? Did they go out and rebid all the contract because they could because spot rates were crashing? Did they the carriers give back all their unprofitable contract because there were better opportunities on the spot market? And barring new information, you should expect some version of that same behavior as the market cycle shifts, and you should plan accordingly.
Absolutely. Okay, guys, couple questions. I know some of you might have to jump, but anyone who can weigh in real quick. As a shipper that is forecasting an increase in rates Q2, what are you doing to ensure routing guide integrity and committed capacity through that cycle and the risk aversion?
I think it would depend on, to me, whether you're working with brokers or carrier or brokers versus asset-based providers as the primary providers of those lanes. I'm a huge believer in index-based contract pricing. You can do it to spot rates, you can do it to contract rates, and all you have to do is pick an index that both parties are agreeable to, and you'll adjust those prices up, with a 1 or 2 month lag, so everybody's made whole. The key thing is that you have to have a 98% guaranteed tender acceptance to make this work, right? Because the whole goal is you pay your carrier more as rates go up in return for them giving you capacity. So, pretty much every price in the universe outside of transportation is indexed to some underlying data. Every chemical sold in the world is indexed to some producer price index. So I would say that to me is probably one option to explore.
And I'd say in the meantime, just make sure everyone knows what the expectations are. Reaffirm what that commitment actually means in terms of term, duration, freight expectations, and make sure you've got a way to track it, right? To know whether you as a shipper are standing up to the volume expectation, you as a provider are standing up to the capacity commitment.
Yeah, I would say the science exists that you can get really tactical at lane management. You can take your demand forecast that drives production, you can put it into truckload quantities at a lane level, and then Power BI tools can tell you, how am I doing? And if you've got lanes out of tolerance, go take a look at them and figure them out.
Really like that. Okay, 2020 to 2023 caused a lot of companies and shippers to invest and analyze logistics much more than previously done due to the spike in costs. Are newer logistics manager roles at shippers going to continue to increase or see a decrease? I think, in other words, we're really asking here, are shippers going to continue to care as much as they've cared? Or are we going to start to see jobs cut on that side? Or is there going to remain heightened visibility?
I think they have to continue. I think that there's nothing but a talent shortage in supply chain. And say what you want about COVID. I think one of the silver linings was it made supply chain, for lack of a better term, right, sexy, where you couldn't go a day without a port disruption or just some calamity impacting global supply chains. And I think really brought to the forefront into the boardroom the importance of logistics and supply chain management. I think going through the next cycle, I don't think that has changed. If anything, it's it should be I think a great time to be in the space and either pursuing a profession in logistics or transportation management or studying in school or continue to kind of climb the ladder.
Okay, one more here. Any thoughts on how the topic of sustainability will continue to be tackled or talked about in 2024 with many companies rethinking their supply chain lines? Is this going to continue to be a hot topic?
BlackRock just laid off basically their entire ESG division and pivoted to Bitcoin. So I think that's a little harbinger of how people in recessionary times think about sustainability. But go ahead, Jason.
Yeah, hot topic. Yes. Do people actually change behavior? I'm not convinced of that.
Right.
But if you can align sustainability with cost savings, it's again whether you're talking about moving freight from the road to intermodal or underutilized truckload shipping, and shared truckload, and hey, you're saving a boatload of dough, and hey, you're also saving a boatload of unnecessary carbon emissions. Great, we'll take the carbon emission savings, but that's probably not why they're making that decision.
No,
I think what I'm hearing here is an investment in expensive EVs and infrastructure to make them attainable going to be something that's really focused on in 2024 with this current environment. I'm going to say maybe not as much as we would have thought a few years ago.
Not in an election year where there could be very big policy ramifications. I mean, I'm waiting for the first shipper to say, you know what, I'm going to transition from truck back to boxcar rail and order 4 times the quantity and sit on that inventory because it's a little nicer for the environment. When that happens, I will start getting excited. The railroads don't seem to give a darn about that volume though either. So to me, that's when people are saying these investments, like, does that mean you're going to switch to rail? Does that mean you're going to switch to short sea shipping in the United States? Because until I start seeing massive changes in that front, I ain't going to get excited.
Jason, you bring up a great point. So we had a bunch of management consultants in, and we were talking, and they laid out their grand plan for how autonomous was going to happen in the U.S., right? And they said it's going to be a hub and spoke system, and the autonomous vehicles are going to go from one hub to another hub on a fixed route. Yeah. And I just kind of sat there and took it all in. And at the end, I'm like, you know what else operates in this exact fashion and is like single-digit share of all transportation? Trains.
Yeah, I mean,
no one's willing to slow down or deal with drayage and damage at a level of the North American truckload, right? North American truckload is $800 billion. What is intermodal? Less than 100?
Well, here's how I look at it. Just some figures for everybody to think about. We move in this country every year. I'm going to ballpark 300 million truckload shipments. That's based on the commodity flow survey, give or take 300 million. Most of those shipments don't go more than 300 miles. Most go less. Where's platooning going to make sense in most of these? Like, folks who are obsessed with autonomous pick Los Angeles to Phoenix. I'm like, that is fascinating. Do you not realize there's a lot of freight that goes east and not much that comes west? So you're running your really expensive toys back empty, or you now have to find stuff out of Phoenix to the other part of the country, and that ain't that easy. So the autonomous push, can you put it best? If I'm going to run across the country, I'm just going to put it on a train. That makes way more sense from a carbon footprint standpoint.
I would say that maybe, and I love how honest we're being in this conversation, because anytime you try, from my experience personally, when we try to get people to talk about sustainability on stages, it's very optimistic and it's very forward thinking. And I think that what we have maybe done in the sustainability space, similar to what we did with digital freight matching, was have some people from outside of the industry looking in and coming up with these grandiose ideas that then when you go to implement and execute, don't quite function as well as you would have wanted them to when it actually comes down to how does a trucking company still need to be able to operate when they're moving
right?
Truck drivers do a heck of a lot more than drive too. So the other, I can't stand autonomous. This is becoming very clear. But drivers do a lot more than just drive. The Bureau of Labor Statistics has a great report on that. But then there's one other thing. No truck driver wants to babysit a computer. Drivers take pride in their ability to drive and operate their vehicle in any conditions. My dad was a driver for a while, so I've talked with him about it when he was alive. No trucker wants to be a babysitter of a computer. When the industry says, oh, this will fix our labor issues, it will make it worse. it will make it way worse than it is because no good driver wants to babysit a computer.
Yeah.
Yeah,
think
there's
that's a
never
real
been a history of technology making something worse that it was intended to make better. So I don't think we have any concern.
Nah.
About
Oh, yeah. So yeah, no, I mean, Facebook made the world a better place, right?
so much better.
Wow, we talked about Facebook and Ozempic, and I'm just like, this is not where I thought today was going to end up. But I love the conversation, guys. Anybody else have any last thoughts? I think we've hit most of the questions here that we got from the audience, and I just want to give anybody the opportunity to chime in if they have something to add. Speak now or forever hold your peace. Okay. Well, I also wanted to let everyone know that I will have the next edition of the January Truckload Market newsletter out this week. I do actually collaborate with two of the gentlemen on the screen, Ken and Jason. We kind of toss around some ideas every month. Maybe Picket Research is going to collaborate with me on that soon too. You never know. So thank you guys so much for joining today. You guys were awesome. This was a lot of fun. We might have to do this again one day. I say that every time I have Ken and Jason on, and they keep coming back. So it's lucky for all of us. But thank you guys. I appreciate everyone for joining us today. We hope you guys enjoyed the show. And thank you all for meeting us for coffee today.
All right. Thank you.
Everyone.
Bye-bye.